What's up, everybody? My name is Demetri Kofinas. I'm a media entrepreneur, financial analyst, and the host of Hidden Forces, a podcast that helps investors, entrepreneurs, and everyday citizens get an edge by equipping themselves with the knowledge needed to anticipate the challenges and opportunities of tomorrow. By sharing my critical thinking approach and by challenging consensus narratives about the power structures shaping our world, I help you make the connections to see the bigger picture, empowering you to make smarter decisions. On this week's episode, I speak with Nikhil Shamapant, the author of a recently published and widely circulated 79-page report on Ethereum, EIP 1559, and the ensuing move to proof of stake, and the implications of these two protocol changes for Ethereum's structurally available supply, and thus its price. Nikhil makes a compelling case for why Ethereum is positioned to soon become the preferred savings vehicle in crypto, displacing Bitcoin as the so-called God meme around whose orbit the entire crypto complex will begin to circulate. Nikhil has put out an ambitious 18-month price target of $150,000 per ETH, more than 30 times the current level, which he believes will be driven primarily by changes to the underlying Ethereum protocol, which are scheduled to take place in two phases, beginning with the adoption of EIP 1559 in mid-July of this year and culminating with the formal transition to proof of stake in late 2021. Those of you who have been longtime listeners of this podcast will know that I am an investor in crypto, but this hasn't stopped me from being highly critical of the space, including the toxicity of the culture particularly present among Bitcoin maximalists, the casino culture of DeFi, and the self-serving narratives around inflation and national decline that are disseminated as canonical wisdom among many in this industry. Still, we find ourselves in a dilemma as investors, which is that while some of us may want to hold market participants accountable for their irrational exuberance, sloppy valuations, or in some cases outright fraud, regulators and the public at large have been more than happy to look the other way, and policymakers have reinforced at every opportunity the expectation that governments are there to ensure that markets keep rising and that the economy keeps booming. Out of this behavior has emerged a phenomenon that I've repeatedly referred to over the last few years as market nihilism, an investing philosophy that treats objects of speculation as though they were intrinsically worthless, and it has increasingly become the dominant belief system for an entire generation of investors, with wide-ranging implications for asset prices across markets and the economy. Today's conversation is meant to expose you to an investment thesis that seeks to capitalize on this trend by removing any reference to value, focusing exclusively on structural forces of supply and demand. You're going to learn how specific changes to the second most valuable cryptocurrency could dramatically reduce its supply during a time in which demand for the asset could be rising substantially. Nikhil estimates that the structural changes we're about to see in Ethereum are the equivalent of 3 Bitcoin halvings, and that the narratives currently forming around these changes will combine to create a mania in demand for ETH that could push its price to astronomical heights in a very short period of time. You could think of this as a leveraged bet on the continuation of the crypto bull market, and as further speculation on the rise of DeFi as a sustainable trend in the short to medium term. For those of you who are interested in understanding the protocol changes discussed today in greater depth, I've recorded an additional hour-long conversation with one of EIP 1559's main champions, Tim Beiko. Tim and I cover in much more detail the specific changes to the network fee model discussed in my conversation with Nikhil, including changes to the user experience, the impact on miners and miner extractable value, network scalability, staking rewards, and much more. You can find that episode on our Overtime feed, and you can learn more about how to become a Hidden Forces premium subscriber by visiting our website at hiddenforces.io or subscribing directly through our Patreon page at patreon.com/hiddenforces. Given that this is an investment-related episode, I want to be absolutely clear that nothing discussed on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. So now, with all of that out of the way, please enjoy this week's episode with my guest, Nikhil Shamapant. Nikhil Shamapant, welcome to Hidden Forces.
Hey, it's good to be here.
It's great having you on, Nikhil. So are you in New York City?
No, so I was based in New York City before for medical school. Right now I'm in Austin. I'm kind of in transition. So
are you going to go back? So you're at the Icahn School of Medicine, right?
Yes, and I have 1 week till graduation. So I'm heading out to Denver, actually, to do my residency at the University of Colorado.
Oh, hey, congratulations. So you basically did everything remotely. For me and my audience, I mean, I know a little bit about you, but give me a basic background. Like you said, you're in medical school, you're going to do your residency. And how did you get involved in crypto? Because we're going to talk about a thesis that you put out recently, only a few weeks ago, that's gotten a lot of traction in the broader crypto community. So how did all this happen?
Yeah, I'll keep it brief, but when I was 15, I started getting interested in markets. I was particularly interested in equities. I didn't know really what anything was, so I kind of grasped onto the concept of stocks and started the traditional value investing, education. I learned a lot about stocks for a couple of years, and then I was interested in markets and kind of kept in touch, but mostly put that to the side during the meat of college and medical school. In college, I majored in philosophy and cognitive science. And then in medical school, the first 2 years, obviously, it was just in the thick of learning medicine. This past year, when COVID happened, initially it was busy and I was in New York kind of helping out. But around late April, early May, a lot of things started to wind down and I found myself with a lot of extra time. And at the same time, the narratives around the Bitcoin halving started to really increase. And I was just seeing a lot of news about it. And I was like, what is this? And so that kind of drew me into looking into Bitcoin. And I think, from there, it just naturally drew me into looking into the rest of crypto.
So you had no experience with crypto up until 2020?
No experience at all. And most of my understanding of the 2017, I was hearing about cryptocurrency before, but not as an investment vehicle. I was hearing about it when a friend of mine would be like, we bought some Bitcoin to, get a fake ID in college or something like that. And so it's like, when people are like, all these narratives of like Bitcoin for criminal activity, I bought that completely because I was like, look, that's the only context I've been hearing about this. Never took it seriously as an investment vehicle. But then, in 2020, I started finally looking into the actual monetary policy use cases, the discussion about a store of value, comparisons to gold and gold being held in central banks. And that's just a whole rabbit hole to go down, right? And that's why it's taken a long time, because after that, even then, you don't really touch on Ethereum. So that led me then next to, okay, well, what is Ethereum? And starting to learn from there.
So how would you describe your acumen as an investor in financial markets outside of crypto before 2020?
Yeah, I'm very familiar.
Because your analysis focuses very much on flows.
Yeah. I'm very familiar. I have a good handle on what's going on, why. I cannot say that I have more experience than an average retail investor would have, mainly because I'm a medical student. I don't have the cash flows to be trading in and out of markets. So most of my strategy was long-term oriented, just to avoid fees and taxes. But I've kept an eye on flows-based approaches, just because you learn quickly when you're a value investor and you say, this company is going to be worth 10 times what people think it is. And then, the company just starts falling like a rock and you're like, why? And you just learn very quickly that your theoretical models only mean so much without flows, without someone agreeing with you and buying.
Fascinating.
Some reason.
I'm fascinated, and we'll try to discuss this. I'm fascinated in how, because part of this is a conversation about generational perceptions and differences and how different generations view the world. You're roughly 26 years old, right?
Yes.
Really smart kid. If you don't mind me calling you a kid, clearly you're finishing medical school at the Icahn Institute. You're going to do your residency. You're certainly no dummy. And your focus as an investor is in some ways rather sophisticated in terms of structural analysis, but there's also this emphasis on narrative is fascinating. And again, it speaks to something that I've talked about on this program before around nihilism. I call it market nihilism. You and I talked about this briefly before we started this conversation. And there seems to be a sort of embrace of non-value oriented metrics for pricing assets in today's market. And I think that is informed by how markets have behaved over the course of the last 10 years. And the fact that you are coming into this market as a very young, you have no experience basically in the prior business cycles. It's fascinating to get your perspective and how you view this, because I think it's representative actually of a lot of people, which is why I was actually surprised that you hadn't spent any time looking at crypto prior to 2020, just given also your demographic. So let's start with a thesis that you put forward in this paper.
If it's okay, if I could just clarify one thing as well. When I talk about narratives, I know you were saying that you see that as distinguished from value, but I know that there are people in my generation who will look at something like Dogecoin and talk about a narrative in a way that is completely distinguished from value. I want my discussion of narrative to encompass value. So if a company is priced at $5 and you say that I have a discounted cash flow model that says it's worth $10, I want to say that in order for you to be right, the narrative has to change to convince investors that you are right to buy that stock below $10 and start selling it at $10. Otherwise, your value-oriented thesis will fail. And so when I say narrative, I actually think of value as a part of a narrative. And I think value investors who fail to convince other investors of their value narrative are going to not see their investments succeed. Does that make sense?
Absolutely. And what I'm actually focusing in on, so I mean, I have a lot of thoughts about that. One of the things I would say is that in my experience, this is a recent phenomenon where investors, retail investors, are coming into this market with such a sophisticated understanding of price and what drives price, as opposed to coming in and saying, okay, this is undervalued or this is a good buy, or using this particular traditional model of value investing in order to determine when and how much the purchase of a particular stock. And add on top of that, I think there's also another phenomenon, which is, and I think you talk about this as well in your paper, which is that you think that value aligns with the narrative that you're putting forward. But your larger point is it's irrelevant whether the underlying value adheres to the narrative, because in your view, both the supply side structural dynamics and the demand side structural dynamics in the form of narrative will drive price. So I think that's a more sophisticated way of pricing it. That's also, I think, and in other words, it's not a criticism. I'm not coming at this suggesting, and I think it's also scary. It's frightening that this is sort of the world we live in. And it's something that I don't exactly know how I want to explore with you, but I just wanted to put that out there. We'll see.
Yeah, and one last thing I'll say is, if for the audience who maybe is more experienced with traditional value metrics, I'll just ask them to consider when they look at a discounted cash flow model, when you change small assumptions in that model, the value that you calculate can dramatically vary. You can change the interest rates by 1 or 2% on Tesla, and you can get a valuation for the company that is 10 times higher, right? And so again, I think that I'm a philosophy major, and when I look at a discounted cash flow model that has a 10 times variance on a company, again, I think that's not to say there's nothing useful about looking at value. It's just to say that these flaws with valuation models, we know that they already exist. Everyone has known that. And so when you look at that kind of way of looking at a company like Tesla, you know that what affects the value is what other investors are choosing as the right inputs. And that's a narrative. That choice of whether you should use a 1% or a 2% interest rate to discount, or whether you should say it's going to grow at 20% for the next 5 years or 10 years, that in my view is not because when in hindsight we look at their predictive accuracy, all these analysts are just going to nail it. And we know that empirically, that analysts are not nailing it, right?
Right.
It's about how I can look forward and I can say, look, 5 years from now, Tesla analysts are going to start adding things to their valuation models like robo-taxis. Is that a smart decision? Would I, value it that way? Maybe
right.
not.
Do the facts merit that projection?
Exactly.
But then that brings us to the point about narrative. And again, I don't want to get too caught in the weeds right now, although I do want to explore that. it seems that we're living during a time where the response is, well, it's irrelevant whether or not robotaxis are coming. The question is this a compelling enough narrative to convince enough people? And even further to the point, in a sort of meta way, even if I don't believe it, even if they don't believe it, do we all just kind of suspend reality and believe it? There's this, and again, you said you're a philosophy major. I think this is also very interesting because a lot of this also is a philosophical argument for creating basically targets in space that we sort of all move towards, Schelling points. And it's very interesting to see how the retail crowd, so to speak, the public in general, has been investing in this cycle at the tail end versus in previous cycles, in my experience. And even 2017 is a great example because in 2017, in my experience, it was the founders and the early investors in projects who were the ones constructing narratives, seeding them into the marketplace, and watching people adopt them. Today, it feels like what we have is, sure, there are founders and employees and early investors who are creating narratives, but there's a much more conscious co-creative process between the actual founders and early investors and the broader investing public within crypto. There's a kind of adoption of this idea that it's narrative investing. We've seen this also in GameStop. I did an episode with Lily Francis on this as well. It's just a fascinating thing. And in any case, we'll explore it a bit more. It's one of the reasons that I wanted to have you on. But let's talk about the thesis that you put forward in this paper. The paper is called Ethereum, the Triple Halving. And again, for those who heard our episode in particular with Lily Francis, where we discussed the structural dynamics of options buying, as well as the narrative components and memes and how they were used to drive the demand for GameStop's stock and other such meme stocks, there's a similar sort of analysis happening here that you apply to Ethereum and the price of ETH and why you think it could go as high as 150,000 by, I think, 2020 or 2023. So I know that might sound crazy for people. And I should also, again, clarify that this is absolutely, no one is giving financial advice here. I'm certainly not doing that. And I think as we'll have more of a discussion, people will come to a determination about what they think the point of this discussion really is. But I'd love for you to begin to walk us through your thesis.
Yeah, sounds great. So my thesis is built on these two major catalysts that are changing the nature of Ethereum and Ether as an asset. And these are catalysts that will be happening in the late stages of 2021. So the first catalyst is called EIP 1559. And this is a network upgrade to Ethereum, the blockchain. The way things currently work, when you pay for a transaction on Ethereum, you pay what are called gas fees, and that allows the network to prioritize your transaction, and those fees are paid to miners who are validating those transactions. Miners have very low profit margins. They have a lot of costs, whether it's a huge part of it is just taxes, but then they have electricity costs, employees to pay. Mining is it causes a lot of heat to be generated, so they have to pay for better cooling systems. And so they're selling a lot of their reward from transactions. And so the change that happens with EIP 1559 is that now instead of miners getting 100% of those transaction fees, they'll only get 30%. And that remaining 70% will be burned. And what I mean by that is literally that the Ethereum used in those transactions will be deleted from the network and they'll exit the circulating supply.
Which is another way of saying, it's kind of like saying it goes back into the pool. Because by taking supply out, you're making the existing supply more valuable. So therefore, everyone that's actually holding ETH basically gets that as a kind of...
It's a share repurchase, right? So when Apple announces a share buyback, this is exactly the same thing. They're just removing Ether from the pool, and that makes every Ethereum worth a little bit more. In fundamental terms. And in a supply and demand way, it just reduces the supply.
Right.
So if there's a constant demand, we should see price increase.
It's a chronic structural deflationary pressure on the supply of Ethereum going forward.
Exactly. And so long term, that can have kind of a narrative around it. So for instance, when you model the amount of transaction fees that are on the network right now, you can see that that'll cause Ethereum to have a net deflationary monetary policy. That means that from the end of this year going forward, the maximum supply of Ethereum will end up being functionally capped, right? So it's not part of Ethereum's algorithm to cap it the way a Bitcoin is. But if we're burning enough fees every year, we will functionally end up having a peak of 120 million Ether that have ever existed, and that'll decline by 2% per year, just because so much is being burnt, and the amount that's being burnt is higher than the amount that's being issued.
Right, and there's also a meaningful difference between limiting the supply and limiting the flow.
Yeah, so what I'm talking about
here... In other words,
here,
with Bitcoin, you're actually getting supply that's coming into the market, irrespective of the fact that the supply is capped. Supply is coming in because of the block rewards that miners are getting and that they're selling into the market. They're selling Bitcoin in the market to recap some of the costs that they're taking on. In this case, what you're describing is the opposite of that.
Yeah, so the way I think about it is Bitcoin has a hard cap of 21 million, but less than 21 million currently is in the circulating supply. Investors hold less than that. So let's pick a number. I don't know off the top of my head, but let's say 17 million exist, right? And that means over the course of the next however many years, new Bitcoin that is mined will add to that circulating supply. So that total 21 million will not change, but the amount of Bitcoin that investors hold is increasing. And that's the supply that is determining Bitcoin's price. And that is the supply that's being demanded on the market, right? For Ethereum, all of its circulating supply is its total supply, right? And before this, that total supply was not capped. So right now, let's say you have 100 million Ethereum, there could be potentially infinite Ethereum as more and more is issued. But all of the Ethereum that can exist right now, it's in the hands of investors. And so when you have this monetary policy shift, you start burning Ethereum, you're absolutely right. You get this point where it's not just a theoretical supply change. The actual amount of Ether that is held by investors, total, will go down by 2% every year. Whereas for Bitcoin, the actual amount of Bitcoin that is held by investors will go up as it approaches that 21 million cap. And I think, that's going to have profound effects on price.
Okay, so that's EIP 1559, which deals with efficiency and the fee model. But there's also a proof of stake that's going to come online towards the end of the year, or at least this is something that listeners will know. I did an episode with Vitalik Buterin and Vlad Zamfir in early 2018 where we discussed POS. At that time, expectations were high that proof of stake would have already by now been implemented and operational. That hasn't been the case. So it's been one of those things where people have been talking about it for years and years, as well as other scaling solutions like sharding. Those things haven't happened. So there is some, one does have to wonder, I guess, what has changed now, although I'm going to be doing an episode with one of its main champions right after this conversation to get clearer on that. But let's talk about POS and how that also would impact the supply side of this equation.
Yeah. So one thing I just want to clarify before we move on. I mentioned that this proof of work system, you have miners who are getting block rewards and they're also getting transaction fees, and they're selling significant amounts of that every day on the market in order to cover their expenses, right? So EIP 1559, it reduces the fees by 70%, right, that the miners are receiving. And so that has an effect on that miner sell pressure. Just EIP 1559 alone is a 30% decline in sell pressure. So it's just under half of a Bitcoin halving event, where a Bitcoin halving event is reducing that sell pressure by 50%, right? Or just more than half.
And that's immediate?
Yeah, so that's immediate, exactly, because the day after EIP 1559 is released, miners will get 30% of what they used to get in transaction fees, unless, of course, transaction fees reduce, right? Which is a real risk to mention. But yeah, and then that is immediate. They won't have that Ether available to sell. So that's like a mini halving. It's like the appetizer. But it is a real catalyst, and it's one of two. So the next catalyst would be proof of stake.
Mm-hmm. And that's expected to happen in the fall of or in the early year of 2022?
So EIP 1559 is scheduled for July 14th, 2021.
Right, but I'm saying POS, is that late fall 2021 or early 2022?
So right now, the timeline for that is November 2021. As you said, the way this works is first, let's get EIP 1559, then we'll check what the timeline looks like after that. Would not be surprised if, I think, developers want it to happen as soon as possible, but would not be surprised if we have a month or two delay and proof of stake doesn't come out until December or January. I don't think that would collapse my thesis, because you're right. Like, we've had delays, and I think in order to make sure that the merge happens without flaws, they need to take whatever time they need to take. So
people have already started staking. How does, I guess, again, without getting too technical into this, because we're going to do an episode dedicated on both the expected changes in POS and EIP 1559, but just basically speaking for people that are listening here, what is the timeline for this? How does what's happening now currently? I know that Coinbase recently made it possible to stake on its exchange. How does that all work? And how do you factor that in?
You want me to just briefly explain
Sure.
kind of what proof of stake is?
Sure.
Yeah, so right now we have proof of work. That means there are miners who are running computations, cryptographic computations on their computers. In return for doing that work, they are rewarded with block reward, and in return for validating transactions, they get transaction fees. In proof of stake, we don't have miners anymore. That means that in order to run a node that validates transactions, the hardware is very cheap. So whereas before I might have had to get an expensive graphics card and run my computer really hot, now I can get any cheap computer and I can run an Ethereum proof of stake node. The reason it's that cheap is rather than getting me to put in all of this computational power to make sure that I don't attack the network, proof of stake says you need to stake, which means you need to put up some risk. You need to buy Ether and stake it. And what that means is if I maliciously attack the network, then they will slash my Ether. I'll lose a part of my ETH. So this aligns my incentives with protecting the security of the network. And it's a more elegant game theoretic solution to securing a blockchain. So in return for staking, just like with miners, you'll get 30% of the transaction fees. However, where miners would get block reward, stakers are given issuance. So it's called a staking yield.
So the block reward goes away with POS.
Well,
The block reward is a yield.
Exactly.
It's coming as a yield, as a steady yield, as opposed to a lottery.
Exactly. It's just coming as a steady yield. And one other thing to mention is that it's a yield, but it's paid through issuance of new Ether from the network. So that is not kind of under threat. The risk that you won't receive the issuance is very low because it's algorithmic, just the same way that like the block reward would be. So that's proof of stake. That's what proof of stake is, right? As far as kind of why that's important. So proof of stake, because it's a little bit more elegant, instead of doing brute force computations, we're able to achieve a much more efficient security budget. So the number of dollars that it takes to secure the network, in Bitcoin, you can measure that in the number of dollars it takes to purchase the computing power, to pay for electricity, right? So if you do that for Ethereum, you're measuring how much Ether needs to be staked. And it's an order of magnitude less to secure the same size network. So this has a few important implications. One is that if it's an order of magnitude less, the motto of monetary policy in Ethereum is minimum necessary issuance, right? So you want to issue as much as you need to give incentive to secure the network, but no more than that. So the minimum necessary issuance is going to go down significantly. And then as we'll come to, another important thing to consider is that part of my thesis, I'm calling for kind of insane sounding market caps, right? So even in an illiquid mania, if it achieves my price target of $150,000, we're talking about a market cap north of $15 trillion, right? So there's a lot of dynamic. First of all, I can understand why that gives people some sticker shock, and we'll talk about that. But one thing just to consider is that the threat of like a geopolitical actor trying to attack the network when it's that expensive is dramatically mitigated in a proof of stake system, because it takes an incredible amount of funds to attack a proof of stake system, and it's much more secure than a proof
on the
of
top
work
of your
system.
head, and if you don't know the answer, it's fine. Like I said, we're going to do an episode dedicated on this. But at 15 trillion market cap, what is the estimate for the amount of Ether that would need to be staked in order to secure the network from attacks?
Yeah, I don't have that off the top of my head.
Because
But
there's
I know,
another issue too, which is that you have, and again, this is probably not the place for it, and I don't fully understand how exchanges are facilitating staking, but the idea that you would have a handful of centralized exchanges which would possess this honeypot of ether that is used to stake to prevent the network from being Sybil attacked, that seems like a really potent attack vector. So this, at the very least, I think it's fair to say something, and at least I think it's fair to say, I'm curious what you think, which is that there is a lot of uncertainty here. This is a novel solution that's being deployed, so there is all sorts of risk associated with it that isn't associated with Bitcoin because Bitcoin's security model has been operational and hasn't changed for 11 or 12 years.
Yeah, I completely agree with that. It is absolutely a new technology. We haven't seen anything like this before, and that is associated with the risk of unknowns at every level, with technology or monetary policy.
Okay, so before POS gets instituted and you have EIP 1559 come in and you have this change in fees, POW is still what's securing the network, so the block reward is still in place. So the miners are getting compensated 30% of the fees they're taking, and are those fees, again, not to get too complicated, but are those fees the tips that are coming into the miners?
Yeah, it's gas fees, and after EIP 1559, it'll also be the tips.
Okay, and then the block reward as well, which continues to be something that's issued. You have this regular issuance, but that's going to change with POS. So POS is also going to introduce the yield. The yield generates new supply, correct? That wasn't supply that existed before, right?
Just like the block reward for Ethereum right now is generating new supply. Right.
Exactly. So the yield is actually commensurate to the existing block rewards. You're not actually adding more supply to the network, or the dynamics of new supply in return for securing the network don't fundamentally change.
No, it'll actually decrease significantly. So the mechanics of how it works, because Ethereum never had a hard cap, right? So the block reward was new issuance, and it's like dilutive issuance, right? And the yield on staking will also be new issuance that's dilutive, right? When yields start, block rewards will stop. So that could sound like nothing's changing, but the yield on proof of stake, that issuance will be, I think, like 10 times lower than the block reward.
Wow.
And that's because proof of stake is that much more efficient. Per dollar of issuance, you can get much more security on a proof of stake system, right?
Okay, so now I think we've done a decent job, at least, kind of laying out the supply side. Let's do a summary here.
Yeah, and I can give the quick 3-sentence punch, right? The punchline is, because proof of stake is so much more efficient, because EIP 1559 is leading you to burn 70% of the transaction fees. After both of these catalysts happen, the amount of new issuance that is going to be sold by miners, or in proof of stake by stakers, we expect that to reduce by 90%.
But hold on, before you go there, I don't think we've done a good job of telling the audience what that means that people are staking. So first of all, right now, as I understand it, people are staking, they're locking in their ETH for a year or like 18 months or something. So how does that work that it takes the supply off the market for a predictable length of time? I think that's the significant insight here.
Got you. So right now, we don't have proof of stake, right? In order to make that transition, you need to already have a huge amount of Ethereum staked. Otherwise, on day one, as you try to onboard, you have this network that is, what's Ethereum's market cap? $600 billion that's completely not secured. So you can't just make that transition haphazardly. You need people to stake before you've had proof of stake.
The staking has to be in place before you can take the miners offline.
Absolutely. And so to do that, they have created something called the deposit contract, where people can put their Ether into the deposit contract. That Ether cannot be removed from the deposit contract until after the merge to proof of stake. So right now, I think there's 4 million Ether that is staked. I put the number in my report, but I think it's 4 million right now. And again, that Ether cannot be removed from the deposit contract until we're thinking November, December, right?
So that means basically, if I've got the dynamics correctly, once Ethereum is fully transitioned into proof of stake, people can unstake at any point in time, But what governs their willingness to stake or not stake is the yield that they get on that stake, on the staked Ethereum. And that yield is simply determined by the amount being demanded to stake or to leave. So if people want to begin to sell their Ethereum, the yield on that is going to go up. This is kind of the classic relationship that we see also in money markets and with interest rates and Fed policy.
Yeah, it is, except I will say one key difference is that in like interest rates, a lot of times you see a relationship between price and yield because you have a fixed coupon. And as the price goes up, yields will go down. Mm-hmm. That's not the case for the price of Ethereum in USD, right? So the Ethereum at 2,000 and Ethereum at 100,000 will still receive the same yield because the yield is denominated in Ether, right? And that's a key point. The reason that's important is because it means that if we're seeing yields that are very attractive now, and then the price of Ethereum goes up 3x, they'll still be equally attractive from a purely yield perspective. You might still think there's maybe USD risk, right? But from a yield perspective, what really affects the yield is the number of stakers, not the price of ETH.
Well, I guess I'm not, at the risk of confusing the audience, I'm not fully following that, because if the price of Ethereum drops relative to the dollar, that suggests that there is increasing demand for dollars relative to ETH, correct?
Mm-hmm. Yeah.
And that would be suggestive of some type of diminishing demand for holding Ethereum, right? Which would suggest also a need to increase the yield in order to entice people to stake.
Yeah, so they might have like a reflexive relationship, right? So if the price of Ethereum drops dramatically and that causes a lot of people to unstake their Ethereum to sell it, right, then we would see the yields go up.
Okay.
But those markets are potentially related, but they're dislocated.
Got it.
Versus a treasury bond where the price goes down and the yield has to go up. Like that's how yields are calculated. The yield on Ether is not calculated from the price of Ether in USD. Okay. Does that make sense?
Sure. Yeah. Makes sense. So, so you were summarizing this now. Now that we got this out of the way, we're explaining the relationship of staking to supply and why that takes supply offline. Give me now the supply side of this equation, because there's also a demand side that we're going to talk about. But what you're putting forward is this idea. Again, the paper is called Ethereum, the Triple Halving. And the idea is that EIP 1559, those changes, along with the move to proof of stake, is going to be the equivalent of roughly 3 Bitcoin halvings, which means the equivalent of 3 4-year cycles of dramatic declines in supply, which has an obvious implication for price.
Absolutely. So the primary part of my thesis is this triple halving idea, which is talking about the supply of Ether. And so what I'm arguing is that at a baseline, whether it's Bitcoin or Ethereum under a proof of work system, there's a certain fraction of the supply on the market every day that's coming from miners selling. And so when Bitcoin undergoes a halving, that supply from the miners, not the total supply, but just the miners' supply, is cut in half, right? And that is, in the short term, it's not going to cause price to go up. So on the day after the Bitcoin halving, if you check, you're not going to see the price of Bitcoin jump. But over the course of a few months, that small effect can eat through the supply on the market and cause the price to increase. My argument is that Ethereum, when it undergoes EIP 1559 and proof of stake, it's going to have a 90% reduction in the sell pressure from miners. And so if you do the math, you take sell pressure now, you multiply it by 50%, you do that again, you're still going to get 12.5%. That's still a little bit more sell pressure than we'll actually see in Ethereum after the proof of stake merge. And so that's where I got that number from. But I want to clarify, that doesn't mean that if you take Bitcoin maybe went up 10x in its last halving, that does not mean that it's just going to go up 1,000x, right? I mean, it's a supply and demand flow that is equivalent to 3 halvings, but you can't just linearly extrapolate that to price. You have to kind of assess what price could do through different means. But it does tell you, like, this is a big catalyst. This is not a catalyst that you should underestimate, right? And that's my point.
Well, and it's dependent on demand.
Yeah, and exactly. It's the amount that this catalyst affects price is going to depend on demand drivers, and it's also going to depend on broader illiquidity, right? So this is a supply catalyst that affects a very small portion of the daily volume of Ether, right? But as I talk about in my report, or when we talk about staking, for instance, that's a different kind of supply catalyst where the more Ether that gets staked, the less there's available for new investors to buy, right? And so the effect that these catalysts has on price will be magnified by the amount of Ether that is staked and magnified by the amount of Ether that is demanded as well.
Yeah. And which there's a lot more to analyze there as to what could drive people to want to stake, but we'll put a pin in that for now. Let's get to demand drivers. And so far, we're also assuming an environment where there is no exogenous shock to the demand for crypto, because anything could happen to destabilize this market. But let's assume the status quo. What do you see as the demand drivers that first feed off of people's understanding, increasing understanding of the underlying supply dynamics? So this is something that we saw in the case of Bitcoin, right? Which, people saying the halving is not priced in. This is what happens after the halving, et cetera, et cetera, et cetera. And everyone begins to be educated in the community around what it means, irrespective to your point about whether what it means what it means. People
Right.
develop a narrative
Absolutely.
around what it means that all these things are going to happen and how they should behave accordingly, given the expectation of what's going to happen to the price. So what are those demand changes that you expect to see before we get into any other things, like, for example, the demand for applications, DeFi, for example, the increasing use of DeFi and other dApps on Ethereum driving gas prices and driving the demand for Ethereum and staking? Let's just focus on that for a moment.
Yeah. Part of my thesis is that, this halving event is a dislocation of supply and demand, but it's pretty small. But what happens is when it applies over time, you start to see the price increase, and it might be initially muted, but it also feeds into a narrative. So if you see that the halving happened and then 3 months later, the price of Bitcoin's up 50%, you might think, oh, they were right. The halving was not priced in. I should buy. And, when
I'm going to be poor.
Right, exactly. Have fun staying poor.
Right,
exactly.
I'm going to be poor. I'm not going to have a seat at the Citadel.
And so then when Bitcoin proceeds to go up from up 50% to up 1,000%, how much of that increase is a structural flow versus a narrative flow? I bet most of it is narrative. But I think, how do you get narrative? I argue that price is what leads narrative, and that when you get that first 50% increase, it confirms a lot of people's theories. They go, oh, there was an argument about whether the halving was priced in. It's not. And if it's not priced in, then we know that halving events lead to 10x increases in price. So we'll buy, and we're not going to sell until we see that kind of a reward. And that's a self-fulfilling prophecy. I talk about in my thesis, there's so many other things that I think are going to come in to confirm the narrative further. I think for Bitcoin, it honestly amazes me that you can get so many flows off of the narrative, because for Bitcoin, that is what it is. When I talk to my friends who are maybe not in crypto, they honestly are the digital gold metaphor is something that investors who study gold as a non-correlated asset, is it an inflation hedge? Does it even do that well? Even investors aren't sure that gold is an investable asset, and it's controversial, right? Mm-hmm. But non-investors, not a chance. And yet Bitcoin manages to attract this much inflows just from purely narrow monetary policy narrative and mania, right? So I think you're going to absolutely get the monetary policy narrative when Ethereum is deflationary. You're also going to get the price increase that leads to that narrative adoption, but you're going to get it in a higher magnitude through the 90% reduction in supply than you're getting in Bitcoin's 50% reduction in supply. So that alone should tell you that something very big is about to happen. But then I talk about in my report, there are more aspects of Ethereum that will cause narrative adoption. Because when I talk to my friends about Bitcoin, what they can't understand is, if gold is just a rock, why do you hold a digital rock, right? But if I talk to my friends about a dividend-paying company, my friends are all yeah, this makes sense. This is what responsible investors do.
It's so funny. Are your friends 50-year-old men?
No, for like retirement funds, right? Like,
right. No,
my friends
I say that because I'm used to. The reason I say it, I didn't mean to. I
Sure.
say it because my conception is that your demographic would be able to get this argument much more easily.
My demographic, I think, honestly, I think people underestimate. I think a lot of people look at young people today and think that they are buying something that they don't understand. And look, I don't think a lot of Dogecoin investors genuinely believe that there's some deep intrinsic value there, which
Right.
means that they understand it could be worthless, right? And that means that on the flip side, sure, there are some people who are making terrible mistakes, and it's going to be on the news when they do.
Mm-hmm.
But most of my friends would go nowhere near Dogecoin with their retirement money, right?
Mm-hmm.
Like their retirement is in a Vanguard ETF. That doesn't mean they're not buying Dogecoin, right? Right?
But they get it's a lottery ticket.
There's no delusions here. Exactly.
Right,
Yeah.
exactly.
And with Bitcoin, it's that too. So like there are sophisticated funds who are buying Bitcoin as maybe central banks will buy Bitcoin. This is going to be the world's new store of value.
Mm-hmm.
But honestly, there's a lot of people who are buying Bitcoin because of the same reasons that they bought Dogecoin in my demographic, And when Ethereum has a staking yield, that is not a subtle differentiator of an asset that is complete speculative mania and an asset that's worth buying and holding for the long term. Right? So when you buy GameStop at $400, it's one thing to say, I'm going to buy GameStop and have diamond hands at $400. It's another thing to say, I'm going to buy it at $400, receive a 25% staking yield as I hold it. So if I hold it for 4 years, I'm going to just double my investment just by holding on to if that's the argument, I think GameStop would not have collapsed. You know what I mean? Because everyone would have just been great. I'll buy it, I'll hold it, I'll never touch it. And they'll just celebrate as it continues higher because the yields are so high. It's not a subtle change to the investment narrative.
Well, to your point, I'm looking for it now. I didn't have this in mind to reference it, but I found this thread on Reddit where someone had just staked his or her Ethereum on Coinbase. And what he said was, let me quote from this comment in the Reddit thread. He said, quote, "Went ahead and staked all of my ETH to ETH2 on CB, Coinbase. Immense relief knowing I have no way to sell. Now it is a true long-term strategy. I have accumulated a few hundreds of ETH over the past 5 years and have used the appreciation to pay off all our debts, including the house. Remaining is now out of reach, and it has led to a great reduction in my own anxiety. First time I haven't checked Coinbase 50 times a day. Now it's been 3 days, and there's no reason to do it. It's like my 401k, Roth IRA, and brokerage accounts all in one." I mean, that is powerful. If that doesn't speak to exactly what you just said, I don't know what does. I mean, I saw that when I was reading your paper, and those two came together for me, and I had that sort of kind of aha moment on the narrative side to see how quickly this narrative could really take. Because it isn't just, like you said, there's the yield component, but there's also the fact that I think for many people, there is a relief in simply putting it, sort of set it, forget it. You've followed Mike Green. You heard our episodes where we discussed this in terms of how people invest today. It's non-discretionary. Increasingly, it's just if I have money, then buy. That's it. It's systematic flows. So something similar, in your view, can quickly happen in Ethereum today. And given the supply dynamics, and we haven't even talked about the potential for ETH ETFs, for an Ethereum ETF. We haven't talked about what's going on in DeFi and how that could impact demand for staking. And I also, actually, this might be an interesting opportunity to ask you. Right now, people are yield farming on DeFi protocols, and they are staking Ethereum on DeFi. First of all, what percentage of Ethereum is staked on DeFi? And two, have you thought about how the yield for staking on DeFi protocols will be impacted by the introduction of yield of staking of Ethereum itself for POS?
Yeah, that's an interesting question. So first, I'll address the first part. So right now, 3% of Ethereum's market cap is staked in the deposit contract. So that's just 3%, right? 9% of Ethereum's market cap is locked as collateral in DeFi applications for yield farming, right? Whether that's through lending or some other means. So that's 12% total that is currently locked. I looked at the amount of Ethereum that needed to be staked in order to bring staking yields down to 7%. I just thought, if you have an incredibly fast growing network at 7% yields, I understand that crypto is risky, so it's not going to go to 2% yields, but I thought 7% was a reasonable amount. So when you get to that level of staking, the total market cap, you'd have 20% of the Ether would be staked or locked in DeFi. And that assumes no growth in DeFi, which DeFi has been growing.
Wait, I don't think I understood. So the initial amount of ETH that's going to be yielded for staking ETH is 25%, you said, correct?
That's the best guess estimate for once a lot of Ether has been staked. So we'll see that kind of later on.
But shouldn't yield go down the more you're staking?
Yes, absolutely. And so yields, that's why it gets kind of ridiculous. I include the table that Justin Drake, the Ethereum researcher, put together for this in my report. But, with 4 million staked, which is where we are now, if we had the number that was staked today, because that is enough to do proof of stake. So if we had that number of stakers and we had the transaction fees we're seeing today, right? Stakers today would get 68% yields. Now, that is a number that is so high, I just cannot imagine that we won't see more stakers come in and see that yield fall, right? We're not just going to sustain 68% yields. So when I use 25%, I'm assuming more stakers will come in and drop the yields lower. That'll take some time. That's also a process where more and more supply gets locked up. So as yields fall from 68% to 7%, 20%
so
of
the people
market
coming in right now are getting 68%?
Yeah, they'll get 68% on day one. But again, over the course of the year, as more stakers come in, that yield will drop. So you can't just extrapolate. 68% is an annualized percent, right?
Wait, let me just see if I understand this though, right? They're not getting any yield right now. They're going to get the moment the network transitions into POS, right? They're just locking in a future yield in return for staking today.
Well, and the key detail there is on day one, everyone's not going to be able to instantly stake. There's a limit to the number of new stakers per day, right? So if you're in on day one and yields are 68%, then over time, there's a limit to how fast yields can reduce. But yeah, I expect 68% to move down to 25%. The people who are in at the beginning are going to capture that difference.
So the advantage of getting in early now is that you get the higher yield, but of course there's the cost of the illiquidity that comes with locking up your capital.
Right. And as you said, it's those people, right? It's the people who are look, thank God, I don't want to sell for 10 years anyways. Might as well just lock it in, get the higher yields benefit, and just not even look at it.
I guess one of the questions is, have you thought about this? What percentage of the people locking their capital in at this stage were people that weren't going to sell anyway? They were long-term hodlers, kind of similar to what we have in BTC. Because you have a lot of that behavior in BTC without the yield.
Yeah, I think right now, the 4 million, it's probably all long-term hodlers. So I completely agree with you. And I think that's important to take into account, where I kind of do talk about this, where Bitcoin has this dynamic with the hodling community where a significant amount of supply is functionally illiquid, even if it's not contractually, right? What I argue is not only are we going to see the Ethereum hodling community increase, but it'll be a contractual hodl. So Bitcoin that's a cultural movement. Mm-hmm. And GameStop with Diamond Hands was a cultural movement. Mm-hmm. It was everyone agreeing not to sell. Ethereum is an economic. It's your economic incentives tell you not to sell. No one needs to. There will be a cultural movement around it, but there doesn't need to be, right? You could stop advertising and people would discover, oh, there's a 68% yield. I'm going to stake and not sell. And so I agree that currently the staked Ether is probably Ether that wouldn't have already been selling. And that's why I'm not arguing that the activity before my catalysts in July and November, this activity is not really part of my thesis, right? My thesis really starts with EIP 1559 and proof of stake. Yeah. Because as you said, the Ether that's currently been staked represents people who had such high conviction anyways. Mm-hmm. But I think once staking starts and we see real yields, that's when the media starts picking up on it. And CNBC says, hey, Ethereum's up 50%. And someone on the air says, yeah, and not just that, but people who own it are getting a 40% yield, right? Then you're going to see this dramatic increase in people who are not hodlers, but who decide to be. And unlike convincing someone to be a Bitcoin hodler, where you have to get them to walk them through monetary policy and do all this, just like complex.
Get them to read the Bitcoin standard.
Right. Yeah. For Ether, you just say, hey, you're going to get paid like 50% or 25%. These just huge numbers. And they're like looking at, their S&P 500 index fund and saying, wait, are you serious? Like,
yeah, this is super interesting. Early back in the 2017, during like the base layer wars, one of the arguments there were very rudimentary models for trying to value these networks. And one of the reasons why that was put forward for why Bitcoin would succeed over Ethereum in accruing much more value was because one tended to have the dynamics of hodling, was seen basically as a store of value, whereas the other one was a utility protocol. And some of the arguments guys like Bernitsky put forward had to do with velocity, money velocity. They were sort of half-baked arguments. But what's interesting for me is that something like Ethereum has always had the appeal, and I think this is a mainstream potential appeal, which is that because it has a lot of network activity beyond simply the monetary functionality, so to speak, that it isn't just money, it's also gas for so many applications that run atop the network. There are many entry points for people who might be users of one particular application or another to then adopt the overall network as a store of value. There's also something else that you don't address in your paper at all, and I'm very curious to ask you about it. And that has to do with ESG, both in terms of the regulations around investing from institutional investors who might be concerned about Bitcoin's proof of work and the environmental impact, and just generally the zeitgeist around that. The quote, Bitcoin is boiling the oceans.
Sure.
Let's put aside entirely whether Bitcoin is boiling the oceans or not, okay? But I have found this to be actually a negative narrative that has been forming around Bitcoin. And I think a lot of the people in the space in Bitcoiners who are smart promoters understand this, and they've been working hard to push it away. The fact, and this is one of the areas where a huge benefit that Bitcoin has as a store of value is that it's kind of slow and steady wins the race, It's not move fast, break things kind of technology culture that is or development engineer culture that is Ethereum. This is one of those cases where you could see theoretically that it could cause Bitcoin to fall behind because of the fact that culturally there is this strong preoccupation with global warming and reaching carbon neutrality. How do you think about that? Because that's not something that you address in your paper.
So I do address it in my paper.
I must have missed it.
Yeah, no worries. So it's a huge report. I get it. It's like 80 pages. And halfway through, I talk about a number of different narratives. And so I have one section, it's like page 40-ish, on the climate change narrative. And it's called Climate Change Narrative and ESG Demand Flows. So this is getting right to the heart of what you're asking me. The point that I make is exactly that. So we've seen recently a lot of focus on Bitcoin's environmental impact. That is entirely predictable. Money is flowing into climate change. Solar stocks were on a tear to end 2020. We're seeing money move into renewables. And so if Bitcoin has a concern with respect to the climate, it's going to affect flows. Now, we've seen ARK Invest, Square, we've seen a lot of Bitcoin analysts come out with reports trying to refute Bitcoin's effect on the environment. And in my report, I argue that you don't need to take a stance on this in order to see the effect on flows. That if you are an ESG fund and you're considering putting money into cryptocurrency, just the fact that there's an argument, you can't afford to take the risk that the world decides the other way on Bitcoin. You can't have funds in Bitcoin and then hope that a year from now, everyone agrees that it's ESG. You could wait 2-3 years, and if common knowledge became that Bitcoin actually was climate friendly, great. But right now, flows cannot go into Bitcoin. On the other hand, a lot of ESG, actually in my report, I point out, like, find me an ESG fund that does not have a payment processor. They're ETFs, they all own Visa, they all own PayPal. Ethereum is going to have a 99.5% reduction in its climate impact from proof of stake. It's not going to have any impact on the environment in a negative way. And so it just becomes another payment processor. It just so happens, though, that it's obviously much more expansive and faster growing, and it provides all these yields we've been talking about. And so I argue if you're an ESG fund, and you add Bitcoin, you're going to be afraid that you're going to lose your job if people take the other side. If not investors, but if the world takes the other side and starts to really, nail Bitcoin on this.
Yeah.
On the flip side, I think if you're an ESG fund and you have the opportunity to invest in Ethereum, say through an ETF, you are significantly at risk of underperforming competitive ESG funds that say, hey, look, we have a 2% position in Visa. Adding a 1% position to Ethereum in our ETF is entirely consistent with that. And, Ethereum has no climate questions, so they can outperform with that too.
Yeah. So question here, the staking has an impact on the demand for ETH derivatives versus physical in a way that doesn't exist currently with Bitcoin, right? Because if you actually own Ethereum, you'll be able to stake it and get a yield, whereas you won't be able to do that if you own the ETF, right?
Mm-hmm. So if you own the ETF, you should expect to get a yield. They're definitely going to. So the way that'll work is... I suppose that makes
sense, right? Because the company that's actually purchasing the underlying Ethereum will be able to replicate that yield in its return structure. Makes sense, actually. So last question for you, which is what would kill this thesis? What are the things that could cause Ethereum's price not only to not, let's say, perform as well as you might think, but to actually tank?
Yeah. So a couple of things. Let me start with the tanking question, because I think this, first of all, fantastic question. It really needs to be addressed. So if we had a liquidity event, so if we had like a risk off, the VIX spikes, everyone's getting margin calls, no amount of actually, it's worse than that. Illiquidity works both ways, right? So if you have a supply lock and there's no circulating ETH and suddenly everyone's selling into that, price will tank more. Illiquidity leads to volatility and it's towards the upside, but it's also towards the downside. And so if there were a risk-off event at the right time, you could see kind of a massive decline in the price of ETH. The other thing is, so in the next couple months, there could be a scare, right? Maybe we see miners rebel in a way that is kind of been more substantial than we've seen before. Maybe we see for some reason people say or they're afraid that proof of stake is not as secure as people think it is. Something that kind of really damages the thesis. That's such a big part of the future narrative now for Ethereum that if that were affected, it would really kind of tank the price. So then I just want to switch to ways that this could, Ethereum could return kind of what people think it would normally, where they have 10,000 to 20,000 price targets for this cycle, but it could just not go to the heights that I think it could. So I think that there's a few ways that could happen. One thing I'm keeping an eye on is scaling solutions. Scaling solutions long-term are incredibly important for Ethereum. In the short term, if scaling works, what it means is that the cost per transaction would go down, right? With the same number of transactions. And so that means that the network transaction fees, those fees that I'm talking about are going to get burned, would go down, right? So that it's a good thing, but it's bad for my thesis, right? So I believe
But at the same time, you are going to have a greater demand for ETH as a result of the fact, right? So those two things are going to, it's not clear which one would have a greater impact than the other.
What we're seeing is the instantaneous fees are dropping. So there's been an early rollout of some technologies, and we'll see as the day after the scaling solution is implemented, it's not that the next day everyone suddenly let's all transact on the Ethereum network, right? So there's an instantaneous drop in network fees, but then we're quickly seeing that rise back up. So in my report, I actually case study Binance chain. It's a centralized chain. And I kind of show how it's they're a centralized chain. The one thing they have to offer the world is the fact that their fees are so cheap, right? And so you see them offer these low fees, and you see this explosion, this exponential graph of increase of activity on the network. So the key is the timing, right? So if we see this fees drop and everyone just goes, yeah, but they're about to rise and it doesn't affect price, then great, thesis intact, right? But if the fees drop and people start to think the fees are never going back up, they're just always going to stay this low, that could affect both the narrative and it could also affect the actual structural flows, right?
Odd way though. I mean, I see what you're saying, but it's also an odd way of looking at it, because what you're kind of saying is that Ethereum as a financial speculation, as an asset, will underperform if and when the network actually becomes more efficient.
Just temporarily. right? So the reason I
temporarily, you're not saying that in the long term that would be the case, because in the long term there would be a decline. You would lose the burning. The supply would be greater.
So the key question is, so I have an 18-month thesis, right?
Yeah.
So if we're talking about 5 to 10 years as our time horizon, I just can't see a world where scalability is a bad thing.
Right.
I think in the 5 to 10 years time horizon, we're going to have organic, like when the price of something goes down, like demand's going to go up, and the network fees might temporarily go down, but they're going to, in aggregate, increase to at least where they are now. So I think when you have a 5 to 10 year time horizon, like you should just be incredibly excited about scaling solutions. Yeah. But I was intentionally more aggressive, right? So I made a structural argument around flows in the next 18 months. So for me to be right, I'm very aware that, I'm making a more specific predictions, which means there's more things that can go wrong, right? And one thing that can go wrong is just the timing around when these fees decline and how that affects the narrative around what people expect them to be.
Right. I think also to your point around narrative, the further we get into this cycle, the more unstable it gets, and also the more potentially volatile it gets. And the fact that we had a Bitcoin halving recently, and people who had never been through that before, watch that rocket ship take off, right? And have that G-force impact and having their face rip off as Bitcoin went from $10,000 to $50,000 in a very short period of time. Are going to remember that. If they miss that, especially, they're going to say, man, now's my chance to get into it with Ethereum. So Nikhil, I know that we have to wrap it up, but I want to say one thing, which is that at the very least, I think that people who are invested in crypto should consider, this is not financial advice, but should take a good look at your thesis, because at the very least, it might warrant rotating some of their other crypto holdings into Ethereum. Where if you're already taking risk in crypto, you already have the macro risk of being in this market, you may decide that some amount of this is worth I would just say look at it. I'm not making any other statements about it, but I think it's absolutely worth taking a look at. And there are many other, philosophical dimensions of this argument that we didn't spend much time thinking about, and they concern me just as much as the investment thesis. In fact, I'd actually say more so. I tend to be sort of like some kind of weird cultural anthropologist when it comes to my interest in crypto. But I appreciate you coming on. Give me your, for listeners who want to learn more about you, how can they read your thesis that we've been talking about today? And how can they follow you? And what is your Twitter handle?
Yeah, so my Twitter handle is @squishchaos. And my pinned tweet right now has a thread that contains links to a PDF of my report. It also contains a link to a PDF of a one-pager to kind of give you a quick rundown of the whole argument that we've just summarized. And in my bio on the Twitter, again, @squishchaos, there's a link to a Substack. I haven't been writing too much, but I'm hoping to release more on there.
And for anyone who is new to this program, what we normally do is have overtime segments. So normally I speak with guests for about 2 hours, and the second hour is available to our premium subscribers because we don't take sponsors or advertisers. But in this case, because I wanted to cover the technical aspects of Ethereum as well, I've invited on Tim Beiko, and I'm going to be recording that episode before this episode drops. So both that will also be available on our premium feed right now for anyone that's listening. And if you want to access that, I suggest you head over to hiddenforces.io first to check out our episode library. You can find previous episodes that we've done with Bitcoin maximalists, engineers in the space. Vitalik Buterin, of course, as I mentioned, was on the program. Or go directly to our Patreon page at patreon.com/hiddenforces, where you can subscribe to one of our 3 content tiers. There's also a link in the summary page to this episode with instructions on how to connect the overtime feed to your phone so that you can listen to these extra discussions just like you listen to the regular podcast. Nikhil, thank you so much for coming on, man. This was actually a really great conversation. I really enjoyed it.
I had a great time. Thanks for having me.
Today's episode of Hidden Forces was recorded in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.